Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
So what's the real threat here? If you had to pick one thing, what is the Achilles heel to the dollar? Obviously, losing the world reserve currency status, but what's the driver? It's debt. It's just debt as far as the eye can see that the U.S. is creating. We're eating the seed corn, creating debt in the future that is threatening not only from a sentiment standpoint, but just threatening the whole productive capacity and really the wealth of the U.S. consumer in a very, very big way. Because you think of what your currency is to you as a consumer. Just step back from this idea of trading currencies. Think of it as, the stuff in your pocket, your dollar, is your balance sheet. So it's your country's balance sheet, and it's your claim on wealth around the world. And as the dollar depreciates in value, and the fact that we are a globalized economy and buying more and more goods from overseas, every point down in the dollar reduces your global purchasing power. This is why gold tends to do well when the dollar is pushed down. Gold represents global purchasing power and has to because it's priced in dollars. So that's the driver behind gold is a real economic relationship. Deterioration in the U.S. fiscal position threatens its AAA credit rating. We saw that in a very big way last couple of weeks in the news. Bond King, Bill Gross from PIMCO started to even mention it. Even the thought of that, and as I said earlier, because of the implications of the currency status, really creates some negative sentiment. And I think that's part of the sell-off that we've seen lately in the U.S. dollar in a little bit more rapid fashion than we've seen before, and the fact that its correlation is changing with the stock market. Stock's been going down and the dollar's been going down too, which suggests near-term concern over the dollar as a safe haven play. These are quotes from John Taylor, who was the former Undersecretary of the Treasury. He also did something called the Taylor Rule that drives a lot of the monetary policy for the U.S. Fed and other treasuries, and other central banks around the world. He's a professor at Stanford, I believe, at the moment. But so he's a real heavyweight, needless to say, in the global financial system. And he wrote a piece in the Financial Times just recently, about 3 days ago, really coming out and really just slamming the Fed and the Treasury policies. He basically said the Fed's policy today is the greatest systematic risk. It's not, it's worse than the credit crunch and the financial crisis we faced. The cure that the Fed is trying to overlay onto this is worse than the disease in here. And he gives some stats. The federal debt was 41% of GDP back in 2008. CBO projects an increase to 82% of GDP in 10 years. That's a doubling. But he looks at it and he says with no change in policy, the U.S. debt to GDP could hit 100% in the next 5 years. Now, the 100% mark was what Standard & Poor's talked about, in which countries should start to lose their AAA credit rating. And the U.S. is on that path very, very fast, given their current budget. And what's interesting is the negative sentiment implications that can ripple from this policy would very much make a managed lower currency, which is an implicit weak dollar policy, very, very hard. Meaning, if the dollar starts to come down in a way as it did in the bear market cycle from 2001 to 2008 as an implicit weak dollar policy in order to fund asset markets around the world and try and increase U.S. consumer wealth and get that game with China back in shape, this overlay of debt problem at the moment, which we didn't have before, which was pretty stable, debt to GDP of about 41%. This overlay then means what is looked like a managed move down in the dollar by a lot of smart people can get away from them very, very fast on a sentiment shift. because as the dollar starts to go down in value, and this background is in play, it's like trying to manage the currency in good times is like herding cats. It can get away from you very, very fast. The Treasury and the Fed has seen that over the years. But in a market like this, when you're pumping this much systematic risk out there because of your stimulus policies, it can get very, very ugly fast. And this is again, this goes to the core ability of the U.S. to produce. Taylor says that if the current plans for deficit spending are carried out, and we know the budget is huge, to return to normal debt levels would require a permanent 60% tax increase or an inflation rate of 10% for 10 years. So those are some nasty, very, very nasty numbers from a guy that's worked in the government, has been a professor, that knows a heck of a lot about fiscal and monetary policy, raising the red flag here. And if you look at this, and here's the inflation time bomb, and maybe part of what the move in the longer-term bonds lately are telling us, the big sell-off in longer-term bonds. 100% inflation, 10% inflation for 10 years means basically 100% depreciation of the U.S. dollar. Look at it this way. It's 100% depreciation of your purchasing power in dollars. Current rates, he says the euro goes to 280, Japanese yen goes to 50, and gold goes to 2,000. Those are the plays. Those are the key major currencies in the world people would hide in. Gold, of course, would play that role as the safe haven asset. The dollar depreciates. Gold has to go up to maintain its global purchasing power. It's priced in dollars. So the systematic risk is growing rapidly for the U.S. dollar, and it's because of this massive increase in debt. I had some charts here, and I got them in late to the ISE. My apologies, but let me just give you some numbers here on this. We have March of 2009, Treasury holdings, and again, let's see if we can get something else here. It's still Treasury holdings by foreigners were $3.3 trillion. Okay, 3.3 trillion debt, just Treasury debt. That doesn't include agency debt. It doesn't include corporate bonds, which is another massive piece of this. Of this, China has about 800 billion just treasuries, and Japan has about 700 billion. China and Japan. All right, two of the big players in the world. China and Japan also own a lot of agency paper and a lot of corporate bonds. And if you look at if you see a chart of this, and if you go to the Federal Reserve Bank of St. Louis, you can see this. If you haven't ever gone to the Federal Reserve Bank of St. Louis, they have a massive database of economic numbers, and it's free, and it's a very good source. But the chart is very, very interesting, and it looks something like this. If we have in here, let's just put a graph, what chart looks like this. And we have 1970 on here, and we have 2009 right here. The holdings, foreign treasury holdings, goes something like this, something like this, something like this, blips down, and then just ratchets it up just like this to that 3.2 trillion. 0.2. It just so happens this right here was 2001 when the Fed pushed interest rates down to 1%, and there was a massive amount of derivatives created in the world, and there was a massive amount of Chinese reserves created in the world because of that symbiotic relationship we just saw that was recycled. And not only did China run massive current account surpluses, but Japan did the same.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.